This is JAVIII.fx from JAVIII Empire and welcome. This is our basic class PowerPoint presentation. Right, so let's go. Alright, so this is our overview now. In this class, we're going to discuss the history of forex, key terms, psychology behind charts, market orders, trading sessions, candlesticks, account protection, money management. Alright, firstly, history of forex. Forex is a shortening for foreign exchange. Right, it's exchanging one currency for another to acquire either a profit or a loss. Right? The people who participate in foreign exchange trading are large central banks, institutions, professional traders, and also retail traders. That's us. The smallest footprint in the market. Pips. This is the unit of measure that shows price difference. Or you could say it's the difference between one price and another, or the smallest incremental movement that shows price difference. Whichever one you want to call it. This is usually counted from the fourth value after the decimal point. Example, for GBP USD, we have the 0.528776. The 7 is where we start counting, which is the fourth value after the decimal point. For yen pairs, it is counted from the second value after the decimal point. Right, we have GBP JPY right here, and in this case it's just 3, right? You have 1, 2 after the point, right? 5 and 3. So we start counting from the 3. Right, the last value for each price is called the pipet. It's just a fraction of the pip. These are at the end will move faster than every other digit that's available in the price. Right, lot size. This is the amount each person chooses to enter each trade with. Now, this is considered your value. So you have different type of lot size. You have the standard lot, which is 1.00. You have the mini lot, which is 0.10, which, or you could say 10 cents. The micro lot, which is 0.01, and the nano lot, which is 0.001. Now, key terms, just a few, not a lot, right? If you want more key terms, you can check with the course document. So, buy. When we say buy, or we're looking at the chart to buy, we're expecting that the market price will go up in value for whichever currency pair that we're looking at. Alright, that's it. When we sell, we expect the currency pair to depreciate in value. Right? So take profit now. This is the price we set in profit where we expect to be taken out of a trade in the event that we're not around to close it. Right? Stop loss is the price we set in loss that we expect to be taken out of a trade if we're not around to close it. These two we use to help to control our trading. Break even. Now, this is the decision by each trader to move their stop loss either in front or exactly at the price entry or the entry price. This is to ensure that they do not lose money on that particular trade. You won't lose or you won't make it in worst case scenario. Right? Trend. This is when the market is moving upward or downward in the overall direction. This is said to be a trend. Right? And over here we have some sort of visual representation of that. This up here the market is moving. This on the left, the market is moving upwards, and this on the right, the market is moving downwards. This on the left is an uptrend, on the right is a downtrend. Consolidation. This is when the market isn't following a particular trend. However, price movement is moving rather sideways, right? So you see up, down, up, down, up, down movement stuck in a particular, you could say, box. It's not breaking this high and it's not breaking right here, this low, right? Spread. This is the difference between the buying and the selling price. It is dependent on the broker you are using, right? As you can see over here, the visual representation, down here we call the buy line and up here we call the sell line. So between here and here is what we consider the spread. And it's counted in pips. Psychology behind charts. Now, these are the things that actually move the chart. You have interest rate, which is controlling the largest perspective you can think of. When interest rate changes, then the market will move in the direction based on the change in the interest rate. So if the interest rate turns out to be good, let's say interest rate increases, that will, attract more investors to then invest in that particular asset or, the currency, metal, whatever it is. And then that will increase the demand of said asset. So the price will then move upwards on the overall trend, let's say on the monthly, etc. But if the interest rate decreases, then that will not entice more investors. Then people will actually pull out and go and invest in more assets, in other assets that will actually give them better interest. Central banks move the market as well. They pump large amounts of volume into the market on a daily basis. The central banks in each country controls a huge pool of the foreign exchange market. Professional traders like big companies, brokers, etc. These people also pump large amounts of volume within the foreign exchange market, which also move around money around the globe, right? Hedge fund managers. These people, companies, private equity funds, etc. These people also pump large amounts of money. They accumulate pools of different investors to create this huge volume. Institutional traders, of course, institutional traders will be deemed as hedge fund, professional professional traders, hedge funds, central banks, etc. These are our institutional traders. They are putting a huge amount of money. They are from different companies, brokers, banks, etc. Now, retail traders, that's us. We put the smallest amount of money in the market, or smallest amount of volume in the market. We have the smallest footprint on the foreign exchange market. In other words, we move in the market would be negligible. On the screen, you see pending orders and you see manual orders. Let's look at the manual orders first. Now, these are the ones that you are, more familiar with, right? The manual orders. You have the buy and you have the sell orders. So let's take our attention to the right side of the screen now. Over here, we have a buy order. This is where we enter at a particular price. Our take profit is above and our stop loss is below, right? If you are buying, you expect the market to go up. Of course, your target, your profit should be above the entry, and your stop loss, which is your risk, etc., should be below your entry. So this is your buy order. The sell order, on the other hand, you're expecting that the market should fall or depreciate in value. Therefore, your take profit should be below your entry so that you will make money. And your stop loss, your risk, in the event that you lose money, it should be above your entry, right? Other manual orders would be your stop loss and your take profit, right? Take profit, of course, as I mentioned, is where you expect the market to take you out in the event that you're not around, and stop loss is where you expect the market to take you out in a loss that you in the event that you're not around to actually close it. Now, pending order is now where it gets a little bit tricky. Pending orders are orders that you will place in in the event that you're not around, that the market will activate it and put you in a particular trade. So you have sell pending orders and you have buy pending orders. The types of sell pending orders that you have are sell stop and sell limit, right? And the type of buy orders you have are buy stop and buy limit. So let's look at the sell stop and the sell limit first. Now, the sell limit is where you will expect, let's say the market is already selling and you expect the market to pull, then buy a bit, go back up so that you can be in that trade to take the market downwards. And we have an example right here. This is the current price of the market, and we put a limit, a sell limit. So in the event that the market comes back up as a particular area, then we can then, or pending order will then be activated and we will then be entered into the sell and we can take the market downwards. So the pending order is where in a case that you're not around, the market will just activate it automatically, right? So on the opposite hand now, we have the sell stop, where in the case that the market is already high and it is selling, the market is selling and the current price is above your entry or where you place that pending order. So when the market continues to sell, it will just run into your pending order, enter you into the trade or activate that order and then continue selling. That's what you're expecting to happen with the sell stop. Now, with buy stop and buy limit now, with a buy limit now, the market is buying, the current price is above where you expect to enter. So when the market comes back down, you will be activated so that the market, then you can take the market upwards. The buy stop is where the current market price is low and you put your entry above that. So in the event that the market should rise, you will activate your trade and then you will take the market upwards. Trading sessions, very important. We have 4 trading sessions, right? We have the Sydney sessions 5 p.m. to 2 a.m. Now this is Eastern Standard Time, of course, our time here in Jamaica, right? 5 p.m. to 2 a.m. in the morning. We have Tokyo session 7 p.m. to 4 a.m. We have London session 3 a.m. to 12 noon. We have New York session 8 a.m. to 5 p.m. Right? The market opens 24 or 5 days of the week. So you should realize by now that when the market opens with the Sydney session at 5 p.m., right, in this day, it closes the day 5 p.m. with the New York session closes, right? And then right after the Sydney session opens again. So this happens from Sunday to Friday, right? Market opens on Sunday 5 p.m. and closes Friday 5 p.m. 24 or 5 days a week market. Each trading day closes at 5 p.m. in the evenings and reopen a second after. The trading day Monday will be 5 p.m. Sunday to 5 p.m. Monday. Tuesday will be 5 p.m. Monday to 5 p.m. Tuesday. Wednesday will be 5 p.m. Tuesday to 5 p.m. Wednesday. Thursday 5 p.m. Wednesday to 5 p.m. Thursday, and Friday 5 p.m. Thursday to 5 p.m. Friday. Due to the time difference and geological location, this is actually what is taking place with the foreign exchange market. Regardless of or regardless of we see the market opening on a Sunday and close at 5 p.m. on Friday. Candlestick pattern and candlestick Bible. Now you already should have the candlestick Bible. Now I want you to read through and look at all the different candlesticks and be familiar with what each represents. You should know the wick of a candle, and you should know what the body of the candle, the opening and the close of a bearish and a bullish candle by going through the candlestick Bible. Of course, I can't spend time going through all of that, but in the future, we'll then look at some candlesticks. It is very important that you protect your account, right? Always aim to protect your account balance and improve your skills to be more of a profitable trader. And by doing this, you are encouraged to use a stop loss to control the amount of loss you incur at all times. Always aim to protect your account. Capital retention and account protection, it should be one of the top priorities in your trading life. Money management, by far one of the most important parts of trading. Do not risk more than 2 to 3% of your account balance on each trade. Right? Always aim to calculate your risk to reward ratio before entering a trade using a position size calculator. As a suggestion, if you acquire 2 or 3 consecutive loss for the day, or you are having a losing day, take a break from the charts and just review what you were doing wrong. Go to the drawing board and then try again. Now, these are the things that we actually look at in this class. With that said, if you have any questions, comment below, ask me by email, WhatsApp, or in the group. This is JAVII.fx. Peace.